Hello everyone, good afternoon. I'm Anantjeet and I'm here to discuss some of the Canadian government tax shields which protects an individual from the immediate effect of the tax and defer it for the later stage, which will help you to plan if you're planning to move to Canada, or which helps you to plan about your income or the taxation policies and all stuff. The major tax shields I'm going to discuss are the three here, which will help you to plan about your family, your children education, and your tax savings. The first one is a tax-free saving account, which is also known as a TFSA, which is an account in the banking sector proposed by the Canadian government, a scheme in which an individual over 18 and equivalent to 18 having the social insurance number or the SIN number will be allowed to set money aside throughout their lifetime to make contribution to the TFSA account, so that this money can be it's basically from the income earned and it's non-tax deductible, which means the amount you contribute to this account is non-tax deductible. However, why it's called the tax-free in that case? Because the amount accumulated in this account, when you withdraw it, it's totally tax-free. You haven't have to pay any withdrawal charges on it, and the income grows in the accounts without any tax deductions. The individual pays the taxes. As the individual pays the taxes, I'd already tell on the take-home salary, so they have invested in the TFSA to let it grow, and the growth amount will be non-tax deductible, non-taxable as per the Canadian taxation system. So the CRA sets a limit for the 2023 for this account will be $6,500 per year, and it will have a marginal room for like 60, it's $500 a year. So with the inflation rate, there's a room limit, increases to 500 every year, rounded off to $500. So I just want to conclude the TFSA account with, like, you can contribute $6,500 as a per year to make some savings on your taxable income. This will benefit you to have some savings for the future funds you need, maybe for your dream house or maybe for some other emergency funds. Moving further, the registered retirement saving plan, which will be if you are into the 30s, or maybe you are started thinking about your retirement age, that you must have that much funds accumulated in your account for to pass easily your retirement years. So I assist here, when individuals are planning for their retirement, the contributions made to the RSP account will be a tax deductible. However, will be the tax deductible, allowing the tax from income earned, which means it prevents the limitation of falling into the higher tax bracket at one age. Means you can contribute to the RSP account and falls into the lower category of the lower tax bracket in that case. And further, when you withdraw it in your retirement years, you fall in the lower tax category, because in that case you have lowest earned income, so your financial income will decline. In that case, you will be still paying the less amount to the government as a tax, and you can run your retirement plan smoothly. You have some funds in your account to to spend retirement years very smoothly. The annual RSP limit, which is set by the government, there is generally, if I'm talking about the British Columbia where I'm currently living, so for the 2023 it's $30,780, which is the upper limit or the maximum limit to contribute to this account by the year 2023. But you can how much you can contribute, there's a question in everyone's mind, so I just need to clarify. You can contribute generally based on your income earned, so it is 18% of your income earned you can contribute to the RSP account. As I said, the CRL limit sets the limit, upper limit, as $30,780 for the year 2023. So this helps you, this plan generally helps you to spends easy years of your, as you aged, like the smooth running of your retirements. You need not have to depend on anybody, right? Moving further, I just think about when you have to plan for, you have a family after the 30s or maybe in your 30s. So you plan for your child's education, and it's a huge, here in the Vancouver, it's really huge, the education funds, the fees for the schools and all universities. The higher education is so costly here. So registered education saving plan helps to it's devised by the Canadian governments to help the citizens or the people living in the Canada or in the British Columbia to save the funds for their child's higher education while you are earning, so that it's make a possible funds you needed for your for the higher education of your children. Possibly you can accumulate those funds. The RESP account contribution, whatever you contribute to this account, is non-tax deductible, as these are paid on the income earned, right? Because I just mentioned in the TFSA that if you earn the income, it's already a taxable income, and after that what you get, it's non-taxable, tax deductible. But what happened here, the RESP account, the investment accumulation, like whatever funds are there, whatever funds you contributed, after the tax payable, and then you earn the interest on that as it accrues in the account. The investment grows as a tax-free. However, a little bit of tax is charged when your child withdraw this amount at a later stage to accommodate his or her education, which will be taxed, which is a very low rate, because of the children, they usually do not earn at that age, which is 18 or something, or a little above, you can say. So they fall into the lower income category. There is no such annual contribution limit set for this account. However, the lifetime contribution has been restricted by the government to $50,000 per beneficiary, which means if you have one child, you can contribute $50,000 for them, and if you have another child, you can contribute, is multiplied by the numbers of the child you have. Another thing is the grant given by the the Canadian government. There is the CESG program, which is the which is Child Education Saving Grant, which will be granted how much you contributed to the RSP account, 20% of that, but the annual limit there is set up the maximum of $500, which means you can contribute a little, and the government also contributing to the child education saving program, which is in the form of a grant, right? In the form of a grant. And what else I forgot to mention is, in the child education saving program, you will be allowed to contribute, to make contributions till your child turns 18. After that, you cannot contribute to this account, and till that you can contribute $50,000 per beneficiary, which is a limit, no annual contribution limit. However, the lifetime annual contribution limit, and where the lifetime is 18 years old, I think this is the best plan for their child's future. Thank you so much. I hope this adds value to your knowledge. Thanks.